Welcome back. You're still watching a Metropole Television, but most certainly Business AM. George, still on that question, 3.97 billion potentially off KRA's collection this year if they could have actually adjusted that inflation rate by 4.97%. I mean, we've seen also KRA lose other collection avenues this year, especially when we're talking about that digital services tax as well. Is that us saying that it might be another tough year for KRA when they have their biggest target yet?
If you look at numbers over the last, I think, 3 quarters, they have been surpassing their targets, and in fact, the last one I think they surpassed the target by around 2 or 3 billion thereabout.
Yes.
And then, in terms of collection, I think KRA has upped their game, and we must give it to them that they're really aggressive in collections. But as I told you, Elijah, KRA cannot collect in a vacuum. They must collect in an economy, and that economy must be seen to be growing. If that's not the case, then you might be collecting, or you must be milking a dead cow, and that's not a very pleasing if you are in as an economy. So yes, KRA might lose on the 3.97 billion in terms of additional revenue from that particular tax head. But if you look at the economy overall, then you realize that it's better if the economy is surviving or is seen to be growing, yes, before you go in and try and collect some of these taxes. As it is today, Elijah, the private sector is not doing very well. That I can tell you for sure. Most players in the private sector have either slowed down or have closed business altogether because of the pandemic that we went through and the economic slowdown that we had even before the pandemic. So my take is that KRA, in as much as they managed to collect some of these revenues, they need to realize that you can only collect revenues from an economy and to government. The focus should be on revamping the economy. Money in their If somebody has money, then you can easily go and collect them. In fact, they'll be queuing to come and pay their taxes.
Yes.
But when you collect from a dead economy, then what you're simply doing is undertake a business where you're burying a dead horse. So this needs to be looked at vis-a-vis the collection targets, yes, but again, GDP growth and the disposable incomes of the Kenyan populace, Elijah. You realize that last year most people lost their employment, and most people are really suffering economically during this period. Government focus should now be to ensure that companies come back to operation, that they can absorb the workforce that they shed off in the last few years. So the focus should not be on the monies that KRA is likely to lose in the next quarter because of this particular tax. Because as it is, they're already surpassing their. The focus should be to revamp the economy so that they can from Elijah.
Pretty much. Right, let's move on to the next issue that we have for you this morning. But the Central Bank of Kenya data now shows that Kenya's foreign reserves fell by 21.8 billion in the week of November 18th as a result of debt repayment due this month. Now, the data shows that the reserves stood at 996.3 billion last Thursday, which was worth 5.42 months import cover, down from 1.21 trillion on November 11th. Now, the drop coincided with the period when Treasury was due to make payments worth 28.14 billion in the form of external debt principal and interest payment to 2019 Eurobond, China, and the World Bank. Treasury data indicates that Kenya's biggest external expenditure was in principal and interest repayments for China's bilateral debt at 9.2 billion shillings, with the cash office also paying 8.93 billion shillings in semi-annual interest for the third Eurobond. The regulator is, however, adamant that reserves it holds will be enough to provide cover for imports while maintaining the shilling stability in the foreign exchange market. Kevin, I mean, the shilling is at 112. Let's say average years for the past 2 weeks has been around 111, 112.
Yeah.
I mean, if you look at that, and with the Treasury Office maintaining that the shilling's stability in the foreign market will be maintained, I mean, when you look at that, does it contravene it?
Yes, you've rightly put it out, Elijah. The shilling has been struggling, and in fact, last week it closed, I think, at 112.2.
Yes.
And we cannot see it reversing in the medium term and in the short term, because we are still there's a lot of pressure, especially from the importers, because we are more of an import-driven economy than an export-driven economy. So there's a lot of dollar demand from the importers, especially the energy importers. So we really cannot see a reversal in the trend for depreciation by the shilling. And the fact that now the forex reserves that were supposed to support the shilling in times like this are now being extended to make interest payments, then it's also another worrying thing on our economy, because the current forex reserves can only cover about 5.8 months of imports, and against the CBK's requirement, I think, of 4 months, the EAC requirement of 4.5 months. So if we start depleting these reserves, making interest payments, then we won't have enough reserves to continue to support the shilling, because we are not being able to move our economy to an export-driven economy. We are still depending so much on imports, which is continuing to hurt the shilling day by day.
Yes.
So these are the times that we should really be revitalizing our manufacturing sectors to ensure that we are having a lot of exports. We are supporting the economy through exports, so as we can reduce this dollar demand that is pushing the shilling, that is pushing the depreciation higher and higher each day. So these are the measures that we should be taking, and ensuring that these forex reserves are being utilized for the right purpose, not then extending them to interest payments, which will
Yes.
bring them down, which we
George,
don't want to do.
you hear what Kevin is saying, that it's time for us to focus on our particular sector so that we can actually give the shilling a chance. But George, two questions on that. We do know that for us to correct our forex reserves, majorly what we do is that we will be getting another loan. That's one way. And George, on that front as well, do you expect again that this is the time that the Central Bank of Kenya could be doing something in the monetary market so we correct the shilling? Because the way it's going, we might close this week at the shilling being 113, looking forward to 115.
Elijah, these are the impact of our borrowing that we've been talking about.
Yes.
I think we are heavily borrowed. That is a fact that we must address ourselves too, and that is why Treasury, I think earlier earlier last year, put in place the debt management office, and these are some of the things that they need to address. A 10% drop in our FX reserves is not a very easy thing, and that points to the reason why the shilling is weakening vis-a-vis the dollar.
Yes.
Remember that most of our external borrowing are dollar denominated, and therefore we must pay them back in dollars. But where do we earn our dollars from? It is either through our exports or through more borrowing. And as I told you earlier, we don't export. Our exports have kind of declined because we only have tea and coffee. Our tourism sector has not performed very well over the last 1.5 years, and that tells you why our FX reserves are going down. That's not a very good point, Elijah. And for an economist, that is something that needs to worry central bank, because if your FX reserves are going down, meaning your currency will get weaker and weaker and weaker. We don't want to land into a situation where Zimbabwe landed just the previous years, or where Greece went to, where your currency becomes, so to speak, worthless. That even your citizens don't trust that currency as it is. So that is not a space that we want to go to. And I believe we still have an opportunity to correct some of these issues. we need to look at our debt portfolio very candidly, Elijah, and just take the bullet, Elijah, and move on. I think my opinion would be that we need to slow down on our borrowing and restructure some of our debts so that we push our month-to-month repayment to as low as possible and start managing our revenues to expenditure level, so that whatever we collect, we spend what we can collect and leave the balance for development. That is the only way we'll be able to reverse this trend, and also to try and work on our export avenues, so that we earn more FX revenues to be able to retire some of these debts, Elijah. If you look at our external borrowing vis-a-vis our internal borrowing is equally very high.
Yes.
Meaning we are starving our private sector from the credit that they should have gotten from the local. So where we are, Elijah, is not a very pleasant area to be in, but I believe treasury mandarins, or the economists that we have at treasury, are able to work around this with the help of central bank. Central bank has been very steadfast in warning us about our debt levels.
Yes.
But I think government has not taken heed on some of these things. We appreciate the fact that the government has done quite well in terms of infrastructure development. But now we need to start investing into areas that can earn us FX revenues almost immediately, and that is tourism, that is our tea sector, the coffee sector. We are doing in our oil sector with tallow oil up in Turkana. I don't know how that ended. We no longer hear about it, Elijah, from government. So those are the things that we need to start thinking through, so that we can start earning as much FX revenue as possible. And also, Elijah, one of the easiest ways to attract FX revenues is through FDIs, foreign direct investments in the country. If you look at NSE has been performing very poorly over the last 1 year. And with that poor performance, they cannot attract foreign direct investment in the economy. And that tells you why the shilling is has depreciated over the last 2 quarters, Elijah.
Pretty much. All right, Kevin, let's clear like this then. We closed last week at 112. Do we expect that it might get worse for the Kenyan shilling against the greenback before that money market corrects again?
Yes, that is very true. It's bound to continue to be affected and to continue to depreciate against the dollar.
Yes.
And I will also want to pick 2 issues that George has spoken about. One is on our debt management, because, for example, the Debt Management Office has only given us external borrowing figures as of June 2021. That is a good 5 months down the line. We don't really know how much the government has borrowed in those 5 months in terms of foreign borrowing. So we need to strengthen the structures around that office. I think the fact that it's under the National Treasury gives it a lot of bias towards the government. So we really don't get that good debt reporting from it, which gives us leaves us at a tricky situation at analyzing where we are currently, especially in terms of foreign borrowing.
Yes.
Which currently, I think as at May, the last figures they gave us, most of our foreign loans, 65.2% of our foreign loans are USD denominated. So we are having to fork out dollars to pay these loans. And this is why our forex reserves are hurting. This is why our shilling is continuing to depreciate against the dollar. So we need to really cut down on that borrowing front, so as to ensure that we are not under pressure to fork out dollars to repay these debts. And also that point of growing our exports, we really need to grow our exports so as to avoid over-reliance on those imports, because as long as we are importing more, for example, now our imports are continuing to grow. I think for the last few months are at 1.5 trillion. As long as these imports are there, as long as we have to import oil, as long as we have to import other merchandise in our country, the shilling is going to continue to hurt. So those are the two main focus points that we should be seeing a lot of concerted effort on, which is on taming the the foreign borrowing and also growing our exports.
Pretty much. Gentlemen, at this point, I'd like to say thank you very much to you, Kevin and George, for making time to speak to us here at our Metropole Television.
Thank you, Elijah.
Thank you, Elijah, and have a good.
To you too. You can take them back to the time that they joined us this morning at Metropole TV KE across all your social media platforms. We are at Metropole TV Kenya on YouTube. Once you're there, a sub, and a like, and a comment, and a follow. It'll be much appreciated. Good morning. I'll see you later on.